Hey folks, Burke here. I wanted to give you a quick update on Freaky Friday, August 1st, 2025, a day that read like something straight out of a political thriller mixed with profound economic upheaval. Let me paint the picture for you. In a single day, we witnessed global tariffs, a shocking employment report, a high-profile firing at the Bureau of Labor Statistics, a key Fed resignation, and even nuclear posturing on social media. My first thought was, honestly, is this some kind of disaster movie script? But here's the thing. As chaotic as it all seemed, there's a deeper story here. Today, I want to unpack what really happened on August 1st, what the market reactions tell us about underlying economic currents, and what we should expect moving forward. I'm drawing from Ed Yardeni's market call analysis, published just 2 days later, titled Market Call Freaky Friday. What's fascinating about this is how it reveals that market reactions, while intense, often have deeper nuances than the headlines suggest. Let's break down that incredible Friday. It kicked off with President Trump imposing tariffs on basically all of America's trading partners, a massive trade policy shift. Almost simultaneously, we got this shockingly weak employment report. Then the political drama ramped up. The president fired the commissioner of the Bureau of Labor Statistics, claiming she had rigged the data. Strong words, and it wasn't the only significant political development that day. Fed Governor Adrian Kugler also resigned that same day. According to the analysis, this could potentially allow the president to move faster on appointing a replacement for Jerome Powell. The timing implications here are significant, and almost topping it all off, in what felt like a rare moment of potential nuclear escalation, President Trump announced on social media that he'd ordered 2 nuclear submarines repositioned in response to online threats from Russia's former President Medvedev. It felt like one thing after another, a cascade of genuinely impactful events, all compressed into a single trading day. Now, that was the initial blast wave of news. But here's where it gets interesting. The market call analysis argues that the real story wasn't just in those headlines. It was in how the market interpreted them. You saw the classic signs of fear initially: gold soaring, stocks tanking, yields falling. But dig a little deeper, and something fascinating emerges. The odds of a recession, according to polymarket.com, increased from about 12% to 17%. That's an increase, sure, but still considered pretty low in the grand scheme of things. And here's the key insight. The reason recession odds stayed relatively low was that the odds of Fed rate cuts increased significantly. Specifically, the CME Fed Watch tool showed the odds of a Fed rate cut in September jumping to 80.3%. So how do you square that circle? All this chaos, but the market's essentially betting more heavily on easier money coming from the Federal Reserve. This raises a crucial question. Are markets reacting purely to the headlines, or are they looking through them to the fundamentals and potential policy responses? That big jump in expected Fed rate cuts suggests the market saw the perceived economic weakness not just as bad news, but as a catalyst for the Fed to ease policy. It's a powerful reminder that sometimes what looks like market fear on the surface is the market pricing in a future path for interest rates. And that fundamentally shifts the outlook for assets, often to the upside eventually. Let's dig into that shockingly weak employment report, because the analysis gives us a fascinating counter-narrative, arguing it wasn't as bad as widely perceived. How does it make that case? The nuance here is crucial. While the headline monthly gain was weak, only 73,000 jobs, and we had those big downward revisions of 258,000 combined for May and June, payroll employment overall actually rose to a new record high in July, 160 million workers. Think about that for a moment, a record high, despite the weak monthly number. But there's more. If you look at aggregate hours worked, which is payroll employment times the average work week, giving you a better sense of total labor input, That rose a solid 0.4% month over month and also reached a new record high. This is a considerable distinction. Despite one soft month, the overall trend in total work being done was still climbing to new peaks. The analysis has a theory about those downward revisions for May and June, suggesting they weren't just random statistical noise. The argument is that those revisions make sense because employers were likely feeling uncertain during what Yardeni calls Trump's tariff turmoil. There's also speculation that courts might eventually rule the president doesn't have the authority to impose these tariffs unilaterally, which could lead to importers seeking refunds for duties they've already paid. That adds another layer of uncertainty. Dr. Ed also attributes some of the payroll weakness to worker shortages, pointing to a lack of growth in the labor force itself. Dr. Ed tentatively suggests this might be partly related to what he described as Trump's very effective immigration policies. Looking forward, he expects that faster productivity growth will likely more than offset this slowdown in the labor force, and he has evidence for that productivity claim. Real GDP still rose a robust 3.0% seasonally adjusted annual rate in Q2, even after accounting for those downward payroll revisions. So how does this revised view of the employment situation combine with everything else that happened on Freaky Friday? How does it translate into a market outlook? We know volatility has been high this year compared to the 10-year average, and the market's entering that seasonally choppy period. August through October typically sees increased volatility. That choppiness seems likely to continue after a day like Freaky Friday. Yet Ed Yardeni still projects a potential year-end rally, targeting the S&P 500 at 6,500 to 6,600. The gold target remains $4,000 an ounce by year-end. This is despite the tariffs, despite the weak jobs headline. How does that square? I think it comes back to market resilience and its forward-looking nature. Even with significant political and economic upheaval, the analysis suggests the underlying economic engine, things like productivity growth and corporate earnings, continues to drive longer-term trends. And earnings are indeed holding up. S&P 500 forward earnings per share, the expected earnings over the next 12 months, rose to yet another record high of 301.44 during the very week ending July 31st. The source to Dr. Ed found this impressive, considering what they called the tariffs being a tax on businesses. It's worth remembering that the S&P 500 index itself had hit its latest record high just days before Freaky Friday, on July 28th, at 6,290. So the underlying trend was strong going into all this chaos. What about sentiment? Did everyone get too bullish before the drop? Apparently not. The two bull-bear ratios he monitors, key indicators of investor sentiment, stayed relatively subdued during that last week of July. From a contrarian perspective, that's often seen as a healthy sign. It supports the idea of seasonal choppiness ahead, rather than the setup for another major correction. We've talked about the market pricing in cuts, but what does Dr. Ed think the Fed will do? This is where it gets contrarian. He is sticking with what he calls a none-and-done scenario for the 2025 federal funds rate cuts. This seems to disagree with that 80% market probability for September cuts. Reasoning? Expects upcoming inflation indicators to show tariffs boosting consumer price inflation, particularly for durable goods. He also expects to see more signs of life bubbling up in the labor market data soon. So while the market says cut, 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 his analysis says, hold on, maybe not so fast because of inflation risks from tariffs and potentially stronger labor data coming, pulling it all together. Freaky Friday hits. Looks like chaos. The market reacts instantly, pricing in Fed cuts. Digging deeper, the jobs report might not be as bad as it initially seemed. Underlying earnings are strong, sentiment is reasonable, and the Fed may not cut as much as the market anticipates. This challenges us to look beyond immediate reactions and understand the underlying dynamics. When you see signals that seem contradictory, a weak jobs report headline but record total employment, or tariffs hitting businesses while earnings projections hit new highs, it raises that crucial question: How do you, as an observer or investor, differentiate between the loud headline noise and the deeper, quieter economic currents that are actually at play? After this Freaky Friday deep dive, I think the biggest takeaway is the importance of distinguishing between immediate shockwaves from news and the often more complex, sometimes counterintuitive realities hidden deeper in the data. It's a reminder that even in chaos, there are patterns, analyses, and insights for those who know where and how to look. The market's immediate reaction to price and Fed cuts, despite all the apparent chaos, suggests sophisticated algorithms and investors were looking past the headlines to potential policy responses. The employment data showing record highs in total employment and hours worked, despite a weak monthly headline, reminds us that single data points can be misleading without proper context. And the disconnect between market expectations for Fed cuts and the analysis suggesting limited action highlights how different time frames and perspectives can lead to very different conclusions. As we navigate an increasingly complex economic and political landscape, days like Freaky Friday will likely become more common, not less. The key is developing the analytical framework to separate signal from noise, to understand what markets are telling us beyond the immediate emotional reactions. Whether you're simply trying to understand the economic environment, it's perfectly okay, even smart, to observe the market, to try to understand what's happening. Build a framework, study history, track interest rates, earnings, sentiment, and geopolitics. All of it. But here's the distinction. You observe to understand, not to react. Trying to forecast the economy or time the market isn't just difficult, it's a toxic illusion. The market is too complex, too random in the short run. You won't outguess it, and you don't have to. What matters most isn't calling the next move. It's building a plan that can weather whatever comes, and then having the discipline to stick with it. Over a lifetime, more than 90% of your investment success will come from two things. Number one, owning great businesses, and number two, not panicking when headlines scream. The rest, it's noise. So yes, be curious, pay attention, ask, what's the real story here? But let your portfolio be the grown-up in the room. Because in the end, your job is not to trade the chaos, it's to outlast it. If you want help turning curiosity into a plan that builds wealth, let's talk. If you are so inclined, please like, subscribe, and hit that bell so you don't miss any deep thoughts. Thanks for joining me for this deep dive into market chaos and economic reality. Until next time, stay curious, stay analytical, and always look beyond the headlines.